Hello, everybody. Thank you for attending our webinar on deal quality and deal structure for crowdfunding securities. My name is Andrew Dix, and I am the founder of the Crowdfunding Media Group, and we're the publishers of Crowdfund Insider. And so we've been covering this industry for a good amount of time now. I'm fortunate enough to have two experts to discuss our subject matter today, and I tell everybody is like, well, while I have an opinion that I love to share, it's actually good to hear from somebody that has hands-on experience. So we're fortunate enough to have Joel Steinmetz from Rialto Markets and Mario Claudio Latuga. Did I get that right?
Latuga, you got it.
Latuga, yep. From Republic, to talk about deal quality and deal structure. So first, I want to let the two panelists to share what they do and who they are very quickly, and we'll start with Mario there on the top.
Hey everyone, my name is Mario Latuga. I'm a securities attorney and the director of diligence at Republic. Republic is an investment platform that enables startups and private companies to raise capital from pretty much everyone, accredited and non-accredited, enabling them to invest in startups and private companies through various regulatory exemptions, regulation, crowdfunding, Reg A, Reg D, 506C. And companies can come to us and through these different exemptions kind of find what works best for them, raising $5 million from, up to $5 million from Reg CF all the way to $75 million through a Reg A plus offering. At Republic, my principal role is really evaluating opportunities as they come in, looking at eligibility requirements, seeing what we think kind of works best with them in terms of which exemption, and then ensuring that there's no red flags that can potentially result in investor harm or anything like that. That's kind of my diligence hat, and in the legal hat kind of sitting and enabling all the different business units to move very quickly without breaking things. And as we say we're a fintech company, but we're really also a reg tech company because we deal in this highly regulated securities regime. So that's kind of a quick background on myself and what we do here at Republic.
Awesome. Thank you, Mario. Joel?
Hi, Joel Steinmetz. I'm the COO and co-founder of Rialto Markets. Rialto is a broker-dealer, FINRA-registered broker-dealer, and an SEC-recognized ATS, alternative trading system. And what we focus on is helping companies raise capital. Within the primary markets, it could be Reg A, Reg CF, Reg D, any of those private securities. We will help issuers find investors and raise capital for it. For their company. What we, in essence, try to do is expand the reach of issuers so that they can find investors that they could not find several years ago, and expand the reach of investors to find investment opportunities that they could not access several years ago. And that's what we do as far as the primary market is concerned. We provide the infrastructure. Everything is through technology and is automated. And we provide the infrastructure and efficiency for issuers to raise capital and for investors to invest in those private securities opportunities. Additionally, we offer a secondary trading system. That's our ATS, our alternative trading system, which you can think of perhaps as a quasi-exchange. But we offer that to allow these issuers and investors to participate in those issues and investments in a secondary market setting as well. We are SEC recognized to be able to facilitate the trading of all private securities, Reg A, Reg CF, Reg D, as I said. And within that secondary market, we work with the same issuers and potentially same investors or new investors who didn't get the opportunity to do so in the primary markets.
Awesome. So thank you for that, gentlemen. First of all, I need to thank our supporters, which are Republic and Rialto Markets, as well as Dalmore. Thank you for helping to make these webinars possible. And now I want to jump into the topic at hand. And I'd like to emphasize that this is a subject that's near and dear to my heart, because I believe personally that for this industry to succeed, it has to work for the issuer. The issuer must be able to raise the capital needs to execute on its stated goal. The platform has to make enough money that it can, it's sustainable and it can survive. It can generate a profit over the long run. And the investor must have a good opportunity to make a return on that investment. And it's all about risk. Now, everybody knows that every investment holds an element of risk. Early stage investing is an asset class that holds a greater degree of risk, but it also creates an opportunity for an outsized return if you get it right. Crowdfunding, securities crowdfunding, investment crowdfunding, online capital formation, whatever you want to call it, has enabled a smaller investor, a retail investor, access to early stage deals that they simply did not have access to before. So you could be like your own VC. That being said, it is very, very important that an investor understands what the deal is and what the structure is. Because I've seen a lot of companies that have a really, really cool concept of cool product or service, but the deal terms were garbo. They were terrible. And you could see from the beginning that these investments were just never going to work out. It was just, it was a path to dilution. The valuation was too high. There were just too many challenges from the very beginning. We're lucky that we have these two platforms here, Republic and Rialto Markets, that list quality offerings. That doesn't mean they're all going to succeed, but they have a process that ensures or tries to make certain that the deal terms are clear and actionable, and they make a lot of sense. So for all platforms in the U.S. securities crowdfunding space, there are a grouping of security structures that most all platforms utilize. And so I'm going to start with some of the most popular structures, and I'm going to start with safes. And a safe is interesting, and I'm going to ask somebody else to explain it. But it's not really equity; it's kind of an option. And so I'm going to start with you, Joel. Can you tell me what is a safe? Give me the 1 minute or 2 minute explanation of what a safe is.
I'll give it to you real simple in what it stands for: a simple agreement for future equity. And the basic idea of it is to say that when you invest in this, as an investor in a company that's offering the safe, what they're telling you, what the issuer is telling you, is that at some point in the future, whatever that trigger might be, and there could be a variety of triggers, but let's take the most popular one, which is upon a further raise. So at a later date, when they raise capital, your safe turns into actual equity. So at the time, right now, it does not really exist as equity, but it is something that will, at some point in time, presumably turn into an equity holding. That's the 30-second description of it. Mario, if you want to go into some of the details on the crowd safe, that might be a little bit different.
Yeah, Mario, please do it, because you guys do a slightly different structure. The safe is used by lots of platforms. It was originally created by, it was 500 startups.
Y Combinator.
Y Combinator. They're one of those guys. Yeah. Can you explain what you guys do specifically?
Yeah. So a safe, the safe was actually created because Y Combinator, as well as other industry participants, wanted to make early pre-seed, seed capital raising quicker, faster, easier, with kind of these standard terms. So the safe, which Joel mentioned, is a simple agreement for future equity. So right, it's not actually equity today; it's a convertible instrument, and we kind of have these three different categories that we like to look at these instruments. Hybrids, so they kind of have some debt features, kind of have some equity features, but aren't technically debt and aren't technically equity yet. So you have like hybrid instruments, which the safe fits under, and a SAFT, which is the simple agreement for future tokens, also fits under. Then you have actual debt instruments, so like a convertible note, and then you have equity, common, preferred, etc. So this is like this hybrid. And one of the the key terms of a safe is the valuation cap. So a really amazing thing about a safe and also a note is you're not having, as a founder, you're not really negotiating valuation with the investors yet, which could be like a long, intricate negotiation, because at the end of the day, that's what like the investor is getting, right? They're getting, if they invest a certain set of money, they're getting a percentage based on that money. That's the valuation. The valuation cap is really like the price cap, or the maximum that their interest will convert at. So the valuation cap, at least where we sit at Republic, we're not going to look to negotiate that as heavily as a VC will negotiate valuation for an equity type raise. So kind of the key there, the key first term is the valuation cap. And then you also have the discount rate. So the discount is typically around 20%. And that's what's providing that the investor today with, like, when the investor asks, why should I invest in this company today? Why not just wait till, a year from now? Well, you're getting a discount. So you're actually paying less than that, than the individuals or entities at the first equity financing, which would be the trigger event that Joel mentioned earlier. So Republic does use the CrowdSafe. It's very, very favorable to companies, but we also have downside protections in there for investors, so that if the company chooses not to convert investors, for example, the investor will have the same type of liquidation preference as the last investor. So it provides some downside protections. It also allows companies to raise quickly, as I mentioned. And we also don't like to deviate too much from it, because we have over a million retail investors on the platform, and we want them to kind of know what they're getting each time they look at one of these investment opportunities. With that said, also, if you go to any of these companies that are looking to raise capital, the offering page, which is like republic.com/company, which is basically like the marketing page in a way, all those reps have to be accurate. So, and that lists all the material terms of those crowd safes. It also links to the crowd safe. So like, we're really trying to empower retail investors and people generally to like understand, as what you mentioned earlier, what they're investing, that like exactly the safe. It's not equity yet. You're betting on that the company will go on to raise a subsequent financing or price round, really like, preferred or common equity after that. That's what you're betting on here. Until then, nothing really happens with the safe. So you're really hoping that that's ultimately what happens, and that the company doesn't go belly up or something like that, needless to say.
Right. Yeah. Okay. Absolutely. That makes a lot of sense to me. I think, in the end, you got to read the terms, because each one can be a little bit different, have a little nuance. And safes in general are very popular on crowdfunding platforms. So let's go to preferreds or convertibles. This is another very popular security that's listed on securities crowdfunding platforms. Joel.
So I'll just, that's a good segue, because one of the key components that an investor has to realize in a safe versus a convertible is both of them are going to have a trigger. And both of them, as Matt said, as Mario said, will have the cap potentially on them. So they'll have something, a discount, they'll have the cap, etc. But they both are expecting to come into fruition once some event happens that triggers that to convert into actual equity. A key difference between the two is, as Mario had stated, when it comes to the safe, nothing happens unless that event actually occurs. So if no future capital raise happens, the safe doesn't really have value, whereas a convertible is a debt instrument. So from the hybrid perspective, a convertible really, in a sense, falls into a hybrid perspective. It just acts not as a hybrid, but as two different ways. It starts one and then flips to the other. It starts as debt and then flips into something of equity. But the component part of the convertible and the safe that is similar is that the very important element that you don't have to come up with valuation today. So both of them become of interest for startup companies that are looking to raise capital a little bit quickly. They don't have to worry about whatever the valuation is going to be. They can have that be determined at a later date. The investor is going to take a risk because we don't know what that's going to be at a later date. We don't know what's going to happen. We don't know when it's going to be triggered. But to solve for that risk, there's some benefit. You're getting at a discount when it gets converted, et cetera. So those convertibles become a little more powerful because they are a debt instrument even from the start. So when that investment happens right up front, there is something that the investor gets out of the convertible immediately, even if there is no trigger to convert that into equity, whereas the SAFE will not necessarily do that. Similarly, although the convertibles will have different terms, from a templatized perspective, the template of a convertible is relatively the same. You're going to have various component parts to it that might be different in the return that it's going to give you in the interest rate it's going to pay you, in what the cap's going to be, et cetera. But each one is going to have a similar component. A SAFE can be very different from one to another. So again, as Mario said, there are within the Republic platform, there might be some very similar components within all the SAFEs. But if you look at the universe in general of SAFEs, they're all quite different. They'll all have very different component parts to it. When it comes to a convertible, it's generally going to be the same things, just with different numbers plugged in. Those convertibles, again, become very important at the early stages of the company's existence.
Okay, Mario, a couple quick questions for you. If it's a debt instrument, is it accruing interest over time? And go ahead.
Okay, the SAFE does not accrue interest. So that's one of the principal differences between the SAFE and an actual convertible note. There's no maturity date on a SAFE, and there's no interest rate on a SAFE. So that's what makes a convertible note more beneficial to the actual investor, is that, like, at maturity, you could call upon the note. Now, will investors call upon the note if there's no financing event? Probably not, because at the end of the day, if there's no financing event, they might just bankrupt the company that they already invested money into. So they have the right, but do they do it? Probably not. But yeah, that's like the principal difference: the maturity date and then the interest rate.
Okay, let's jump to common equity. So the SAFEs, convertibles, and common equity are probably the top three structures we're seeing in crowdfunding platforms. Common equity, I think most people understand. I'm going to start with you, Mario. Is there anything of note you want to share about, common equity?
Yeah. So the one thing we don't issue, we don't love common equity. And it's because there's concerns with 12G, which will basically trigger a company to register with the SEC. So like the whole purpose of these regulatory exemptions, CF, A, D, et cetera, is so that you don't have to register with the SEC, because it could be very expensive, it's time consuming, you might not be able to, for a variety of reasons. So if you reach a certain threshold, in terms of the number of investors, each of those investors in a crowdfunding context would be considered a holder of record, and each holder of record will have to be listed, for example, on the cap table. So you run into some kind of registration issues. It's also a bit more complicated from a logistical perspective. So we really gear more towards SAFEs for those reasons. Okay.
All right. I'm going to jump to debt, because just about all platforms issue debt, and there's different types of debt. And I'm going to start with you, Mario. What are the different structures of debt that you see?
Joel.
I'm going to start with Joel, because sorry.
That's all right. I'm going to actually take advantage of having the podium right now and talk about equity just for a second, because we actually deal with quite a lot of common equity. And the reason is because we're probably dealing with certain deals that are a little bit different in their makeup from what Mario does at Republic. We work closely with Republic. We're all friends within this industry and work together. So we deal with a lot of different types of securities that, Reg A may be looking to raise amounts that are significantly more in these companies. And so a lot of these companies are already doing a lot of the reporting with the SEC and willing to take on that expense. So common equity has an interesting take, and I'll segue into debt from this. Common equity has an interesting advantage in that, as you had said, it's quite, Andrew, it's quite easy for people to understand. There are two perspectives that have to be approached when looking at the investors. There's the investor, and then there's the issuer. The issuer needs to know who the universe is going after. So if you're going after a universe that is looking for something that's simple and understandable and really gets the job done. You want an instrument that is easily understandable, and people do understand common equity. So very often issuers will look to do the common equity because they know they're looking for a vast number of investors coming in for their particular issue. Debt, and this we'll segue into debt now. Debt becomes something that's potentially the same, because debt is not so difficult to understand unless you start adding complexities. And now I know, Andrew, we're going to talk about some real estate issues a little bit later, but there is a difference between corporate debt and real estate debt, for instance. It's important for an investor to recognize some of the distinctions within the debt instruments, not only the different kinds of debt that might be available. And remember, convertible is a debt instrument as well, but not only the different kinds of debt available, but aside from that, number two is what are the terms of the debt? Number three is the ability of the issuer to actually service that debt. That'll be an important factor. And number four, what other debt instruments are associated with that issuer? So as we'll talk about perhaps later with real estate, when you're talking about construction loan debt, that's different than common debt. So how they interact and what ability an issuer will have to service the debt, meaning pay the interest rate when it matures, get everything done, etc., all of that becomes a very important element of the determining factor of whether the risk is too high or a good risk to take within these companies.
All comes down to risk. All right, Mario, revenue share, royalties. You guys do some of this.
Yeah, we do some revenue share. Traditionally, we don't use this for like startups. So a startup that's looking to, ultimately raise VC, et cetera, and go on to, IPO, so to speak. We really kind of reserve it for the small, medium-sized businesses that are more, I'd say, lifestyle type businesses than startups, right? Like we kind of segment them a little bit. And in terms of the revenue share, we have both the revenue share note and we have a term note. And those are our two principal instruments that we use. In terms of the revenue share note, it's really interesting for investors, and really interesting for issuers of the companies as well, because the companies are paying based on the actual revenues that are being generated from the company, and they don't have a fixed bill essentially, every month for a set amount, whether or not they could pay it. With the term note, it's much more like, a fixed term, similar to the debt that you would traditionally think of, mortgage payments, something like that. So those are the two primary instruments that we use.
It's a percentage of the top line. Percentage of the top line, right?
Yeah, it depends. It depends. So like if you did percentage of the top line after expenses, the company might not be able to pay that out. So it's really going to be right, top line versus bottom line revenue. It's going to depend at the end of the day. We're going to want to on the investor facing side, you want top line, but at the end of the day, you also don't want to put the company in a negative position where you're going to hinder yourself, so where you're going to hinder the growth, et cetera, and bankrupt the business. So really, at the end of the day, it's going to have to be kind of a dance to get exactly what you want. But we do prefer, bottom line, because that's the actual money that the company has to work with.
Okay, Joel, digital assets in your case, you guys are doing digital securities, I think, aren't you?
Digital securities, very particularly. So in the securities, we only deal with issues that are regulated. So digital securities is certainly something we're very involved in. We sort of sit at the nexus between private securities and digital securities. But they need to be securities. That could be equity, that could be debt, it can be a whole bunch of different things, but it will have to be under a regulated security regime.
So it just has digital characteristics, but it's still security, still regulated like before, but it's blockchain enhanced. Okay, awesome.
Exactly.
Mario, I know you guys are doing that too, but you guys are also doing some crypto stuff. I know it's a huge topic, crypto, DeFi.
Yeah. So we have a similar position to Joel, where we think that if you're issuing tokens, for example, if you're issuing NFTs, for example, these are securities, or at least we're going to take the conservative approach that they are, because this, whether or not something is a security is based on a test from the 1930s, and it's very risky to do this, because then you're essentially engaging in federal securities fraud if you're issuing these without it. So Republic takes a position that a lot of these, what they're issuing, are securities. So we have specific securities instrument geared towards crypto offerings where you want to issue a token. So we have like a token purchase agreement. We have different types of issuances where a company can actually come raise a concurrent Reg D, 506C, and Reg S raise, issue tokens, and then that's actually, falls within a securities offering. So everything's regulated, et cetera. That's the best way to approach these things from our perspective. We're not going to be engaged in any of these, unregistered stuff. Even when dealing with NFTs, we have taken the position that these are, or they're more likely than not securities, or they may be securities, because nobody actually, it's kind of in the air. It's gray. So
we'll figure it out
that's
eventually.
Kind of the position we've taken. Eventually, someone's going to have to. I think recently Coinbase has a class action against them for a number of different unregistered, about 75 different ones. So this will be an interesting case to see whether or not, a lot of these are going to have the traditional indicia of a security and therefore be regulated.
Okay. And there was a lot of talk from regulators, SEC comments that have discussed the need to come to some conclusion, at least some conclusion that will lead us in a direction of whether these items are securities. And as Mario said, we take a similar position that they do.
Okay. So I got two more here that I want to just hit very quickly. Then I want to talk about, what are good offerings and put you guys on the spot because I want to look out for the investors. But litigation funding, Joel, I can't remember. Are you guys doing any litigation funding?
We do not. We're very familiar with it, but currently we do not get involved in the litigation funding world.
Okay. Mario, you guys have just started doing some?
Yes. We've had one on the platform, Apotheo, and it's really going to vary. I don't want to tie it too much into the question. I don't know if you want to focus a lot on litigation financing, but essentially at the end of the day, it's going to be like, investors have to actually understand what they're investing in, and the multiple associated with it, and also the risk associated with it. So as it relates to litigation financing, what we included was some downside protection for investors. So the case that was actually the litigation that was in front of the court and out in California, we have a certain amount of the funds that investors invested held in escrow until the motions to dismiss based on that case were decided, so that 80% would revert back to investors if the case was dismissed, right? So mitigating their downside a bit, because these are risky investments and stuff. So there are ways to provide downside protection for investors in there. At the end of the day, it's kind of the issuer's, right? It's the issuer's determination to make.
Okay, so basically, you put your money in to fund the litigation, and if the attorneys win the lottery ticket, you get a cut of the action. In brief, real estate. Joel, you guys are doing some real estate stuff, aren't you? And we've already covered this, but did you want to add any through real estate structures?
I wouldn't add any. They really fall into the categories, and Mario categorized them pretty well, whether they're equity, debt, or some hybrid of them. We're finding that the real estate world is looking from a digital perspective to get very involved. And one of the reasons is because of fractionalization and the ability to own sort of parts of things. Once again, it's just important to realize that real estate is a different industry than the stock market. So when you're looking to invest in equities and you would go to buy Microsoft and IBM, that's different than owning property. And the difference is not just in the fact of what you're owning and the asset itself, but actually in the rules and regulation and in the deal structure. Real estate is going to have different deal structure, different timelines to it. It's important that investors understand what those timelines are going to be, what the extent of the ability to get liquidity in order to monetize the investment that comes in, and the entirety of the deal structure that you're investing in. So what I mean by that is You might be investing in one piece, but what are the other deals that apply to that particular real estate investment? Because if it's debt, for example, they have to be able to service your debt. What else is out there that might be before you or after you? What is preferred over you or not preferred over you, in order for you to understand how the payment is going to come to you as the investor?
Yeah, that's actually an important point. Okay, so I want to skip to deal quality, because this is, we kind of understand these structures. We're skipping over some stuff because now there's a whole world of alternatives, largely due to blockchain technology and the ability to manage these assets. But when I'm an investor, I look on an offering page on Republic or Rialto Markets or any of these other platforms, and I see a safe or a crowd safe or whatever, and I'm like, okay, is this a good deal? That's what I want to know. A couple years ago, the SEC went out of its way to warn investors off participating in safes, because they either thought they're too risky, too convoluted, investors were not educated sufficiently. What do I want to see in a safe that's good? And that at the same time, people have to understand that everything entails risk. And so I'm going to start with you, Joel. What is a good safe to invest in?
So let's get back to your last point. Everything entails risk. What, we have an issuer that just recently had a quote that said, if you don't take risk, you're going nowhere. So you just need to recognize that everything entails risk. Any investment entails risk. The thing with this safe is it's called, as we said, a simple agreement for future equity. There are things to keep in mind. Are, number one, they're not as simple as you think. You have to be able to look at the details to find out what the component parts are and how you're going to be able to recognize the value of that safe. The second thing is, as we stated earlier, make sure you keep in mind that there may not be future equity. Those are the things that you have to keep in mind to determine what's a good safe or not. Is the company a good company? Is the company going to be able to reach its targets and get to its goals? If it is, you're going to be able to get a great discount and a great deal on the table. That's potentially something very positive. But just looking at it from a purely deal structure perspective might be a little bit difficult. You need to look at it from the company's perspective and determine whether that company, for a variety of reasons, is going to be able to see the safe to fruition, so that ultimately, as an investor, you're able to participate in what you thought you were going to participate in the original investment. That's understanding the underlying company more than the deal structure.
Okay, so Mario, again, if I saw a safe for a really cool company and it said, well, I get a 10% discount when it's valued at $100 million and it's a startup today, I'd say, cool company, I'm not going to invest. I mean, I know it's difficult for you guys because you see a lot of issuers and a lot of detailed offerings, but what does an investor look for if they want to participate in a safe offering?
Yeah, so I'd say the first component about evaluating an opportunity is to actually question where that opportunity is being presented, i.e., what is the platform offering this? And it's not just a plug to Republic. This is to say that certain platforms have higher diligence standards than other platforms. So whereas other platforms maybe take this more intermediary standpoint where we're not going to diligence these deals, we're just going to make sure there's not like overt fraud and let anyone on the platform. So Republic takes the perspective that we actually do conduct diligence and we want to make sure that these look like interesting opportunities. Not all of them will actually make money. Actually, most of them will fail. It's just the statistics of startup. So assuming you understand, okay, this is the platform that is having this offering. The next component, which is what Joel said, is to actually assess a company, right? Look at the team. What does the team look like? Is the team strong? Look at the financials. Do the financials make sense? Do they look like they're growing month over month, year over year? Are they selling something that's interesting? Are they doing the same old thing? Look at the market. Is this something that eventually a VC might want to buy into? Because again, like you're looking for that triggering event, which has to be raised in a subsequent round. If it's a lifestyle business that's never going to really go on to raise a lot of money or a next round, then you probably shouldn't invest in that company because the safe's going to be worthless, right? So you're looking at valuation cap. Does it make sense in light of the other opportunities that are out there? And again, like valuations and val caps are super weird in the last year. I mean, everything is like exponentially higher than it's been in history because the market has been so frothy. So like you have to take that into consideration when you're looking at the opportunity, and also the discount. Is there a discount? I would also look to see if that's safe, regardless, wherever you're looking at it. Does it have some downside protections for you as an investor? Are there any like liquidation preferences for you as the investor? Are there, some like pro rata rights or something like that? So there's a lot of these different nuances. But a bad deal in my eyes is one that has a super, in terms of a safe, super high valuation cap, kind of a weak company, no discount, a series of different fundraising in the past. So like a company's raised 2 different CF rounds, crowdfunding rounds, and they're still not making any progress. Like really evaluate the company. And then if you think it's a good opportunity, whether you invest at a $20 million val cap or $30 million val cap, like it doesn't really matter in the big picture of things, because you're looking for that company to become, a multi-billion-dollar company at the end of the day. That's the bet you're making. If you think you're making a different bet, then you're in the wrong place. That's like the mentality that I would go in evaluating these opportunities.
Okay. All right. It's a little bit convoluted there. Joel, preferred convertibles. VCs prefer this. Shouldn't I want to invest like a VC and look more closely at convertibles?
Well, so crowdfunding is often thought of as the anti-VC. It shouldn't be, but it often is thought of that. They can work hand in hand. But remember, the general VC investment world is going to do something that is going to probably take control of the company, both from an ownership perspective and a strategic direction perspective. Whereas crowdfunding is not. Crowdfunding is basically saying to that company, I trust what you're doing. And as Mario said earlier, one of the things to look at is, do I like management? Do I think they're going to do a good job? Do I think this company can really grow? If the case is, yes, I think they can, then as an investor, what you're looking for is not necessarily are VCs getting involved now, but is this a company that at the next round, if they're, let's say, seed today and they're looking for Series A tomorrow, is it something that the VC world will actually get involved in? If the answer is yes, then you can be pretty confident that the trigger is going to happen because someone's going to come in and take those shares. Preferred is a wonderful opportunity, only going to get into it at the early stages. Usually at later stages, it's going to be really hard to get that the preferred securities of any type. And the reason for it is the preferred is going to give you some of the protection that is not afforded through other instruments. So those things are great to look at and something you might want to go into. But if a company is looking to raise $5 million and is expecting to get that out of 4,000 investors, there's a good chance that it's not going to be necessarily through the preferred method. It's going to be through some other method that will give you a discount rather than some kind of heightened holdings on the company over other shareholders.
So you mentioned something that I think it's important, that if a VC is investing in the same deal with the same terms, that's a strong message, at least from my opinion. Do you guys disagree with that? If I see Mark Cuban investing alongside me at the same terms, I would be more interested in that. Yeah.
Absolutely. If you look at certain Reg A's, they happen to Reg CFs more and more because the deals that, and I am sure Mario will tell you the same thing, the deals that we're seeing in the last 12 months are significantly better than they were 2, 3, 4 years ago. Companies are really
absolutely.
Companies are really taking advantage. So you'll see investors come in $1,000 and $2,000 and $500, and then you'll see someone come in for $100,000 because that person is an accredited investor, high net worth, maybe a VC firm that's coming in with something a little bit more. That definitely should build confidence in what kind of investment you're getting involved in.
Yeah, and I think for did you want to add something, Mario? I know you you looked like you wanted to
Yeah,
jump
I was just yeah, I was just going to say to your question, totally. If a VC is coming in and investing at the same, at the same terms, and if we see if a company is raising concurrently, we do ask that they match those terms for Reg CF investors. So like we do what we can to ensure that, or to the best of our abilities, of course, that Republic investors are getting the same opportunities as VCs. But again, like just on a practical level, VCs are offering, a lot different. They're offering in terms of what's attached to their money, in terms of connections, stuff like that, is different than what Republic investors or Reg CF investors are offering, which is basically just like an army of evangelists, both equally super powerful in my opinion. Which is why, to Joel's point, we're not like head to head with VCs. We're really like, we think it should be done concurrently.
Yeah, I agree alongside, and I want to keep this moving because we don't have a lot of time left. But common equity, again, we see a lot of common equity. I have, heard stories and seen offerings that you could tell that they were going to zero. And frequently people don't understand that they're going to get diluted probably dramatically in the upcoming rounds. We're going to start with you, Mario. I know you guys don't do a lot of common equity, but, in your opinion, what's a good common equity deal?
It's going to be hard to ask for dilutive measures as an investor throwing in, $100. So I think the expectation should be like, you're not going to be afforded some of those same opportunities, so to speak, or protections as someone who's writing a much bigger check. So to definitely keep that in mind. And I'd say with actual equity, you're looking at the valuation again as well. Like, what is this company actually valued at? And does that, now that we're talking valuation, what is backing up that valuation? Is it their intellectual property? Is it like, do they have a track record? Like what are we talking about here really at the end of the day? Because that again is the difference between like the val cap, which someone else is going to go evaluate at a later date, versus a valuation, which that's what you're getting today. So that's kind of the main points I'd say with that.
So I'll say 2 points here. Firstly, the thing to look at most importantly is buy the story, not the stock. Does the company have a good story? Is the company going in the right direction? Is the company going to be able to deliver something really that's valuable? That's first and foremost. Look at the company and what's its value. The second is, as far as valuation is concerned, Mario's point is spot on. It's very important to really understand the valuation. One of the things that you need to look at is in companies at this stage, very often valuation is a tricky piece. Look at comparables. Look at other companies that are within their industry, within that time frame. Are they at the same stage? For example, if you're looking at medical technology companies, are they preclinical? Who else is like that company that's preclinical? Don't look at someone who's postclinical. That's going to be very different. If they've gotten their FDA approval, it's going to be a lot different than someone who hasn't. But try to get the right comparables so you have a good idea of whether the valuation is even in the ballpark. And then make sure that you know the story of the company and buy into the story of the company. If the company is going, like Mario said earlier, you're not necessarily looking for them to get to that cap. You're hoping this is going to become a $1 billion company.
But yeah, you're looking for them to become a $1 billion company, but a seed round is going to lead to an A round, a B round, and and so on. For an early investor that comes to a platform and buys common equity at the seed round at a 5 million or 10 million or 20 million valuation, and then all of a sudden they're raising money at 100 million valuation, and they don't have the opportunity to participate in that, and maybe they don't have the ability to participate in that. Does that create a challenge?
So firstly, you can look at ones that will give you the opportunity to participate in that, and that's something to look for. But second, yes, you are going to get diluted, and as Mario stated, it's really hard to get the anti-dilution pieces into this. But if you got involved at $20 million and you don't have the opportunity to get involved at $100 million, one thing you know is that whatever investment you had just increased by 5 times. That's not a bad thing. So granted, I had 1,000 shares yesterday, and now I have less shares, but I just made a lot of money. And when it goes to $1 billion, I might only still have a very, very, very small percentage, but it's on a company that is, 500 times what I thought it would be. And that's
smaller slice of a much bigger pie.
Yeah. It's a
but
nice.
you can also have such a small slice that it becomes less than your initial investment. And I think that's something the investors have to understand if they don't have the capacity to participate in follow-on rounds. And I'm not ever going to give anybody investment advice because I can lead myself astray as much as I want, and I don't want to do that for anybody else. But I think that's something that people need to understand. Let's keep moving on this because I got a couple of things here before we open up to any questions that we may have. I'm going to skip over revenue. Real estate, there's pros and cons. You see people that are doing debt, people are doing equity, they're doing all sorts of mixing and matching with bridge loans and stuff like this. Mario, you guys are doing some real estate stuff right now. What's a good real estate deal?
We are doing some real estate. The deals that I particularly specifically like are more like real estate technology type companies, which are looking to really change the way that these antiquated systems are operating. So they're more of a it's a startup versus an actual real estate property or something like that. That's what I personally like because the upside is much higher. You also don't have to worry about some of these issues if you actually are investing in some of these LLCs. You have to worry about potential tax consequences with K1s and stuff like that. This kind of avoids some of those issues. So those are really what I'm most interested in is these technology companies looking to change the game for real estate rather than just fix and flips or something along those lines.
Joel, you got any comments?
Yeah, well, firstly, on the last one, I think going for the fix and flips is a little bit more challenging. So I agree with Mario. You should want to think twice about those. But in addition to it, going back to what we had said earlier, when it comes to the real estate side, just whether it's equity or debt, just know what's out there on the other side of that particular structure. If you're buying debt, know what the equity holding is and what the other debt might be. And if you're buying equity, you know what the debt might be. It's important to know all the elements of it. And a good real estate deal is one that the balance sheet or what they're looking at, their future is something that will be able to service what they're trying to provide to you. Remember also that when it comes to real estate, very often at the early stages, there is going to be an elongated process until it actually delivers some value. Might be, whether it's shovels in the ground or not. If it's pre-shovels in the ground, it's going to be a long process. What is necessary in order to get that company to that conclusion? Because if they need $100 million and they're raising 20, then you've just thrown out the money that you put in there because they need another 80. But if they have shovels in the ground, they only need X to accomplish what they want, and they're getting that. Now it's going to be something that could turn into a profitable venture.
So you made a good point. You want to know the capital stack. You want to know, the debt and equity structure and where they are, because that makes a lot of sense to me. Very quickly, digital assets. I'm going to jump over to you, Mario, because airdrops, DeFi, you guys are doing it all. We don't have enough time to tackle all this. What's a good deal that is regulatory compliant? I know that's an issue.
Yeah, no, I think that share drops are a great example of kind of the approach we've taken to these offerings, where we do view them as securities in return for, instead of an investor actually paying cash or giving us PII or giving the issuer PII, personally identifiable information, which is consideration, which would likely lead this to be a security. So I think in the realm of, all digital assets, you need to be really, really cognizant on who the actors are in it too, because there are more nefarious actors that come out of the woodworks to participate, because it is a bit of a grayer area. So using a a platform that is reputable, understanding who are involved, who are the players here that are actually selling these things, what am I getting when I'm buying a token, is the token actually out yet, or is it being minted? And by the way, if it's not out yet, that's totally fine, but these are just questions that as an investor you should ask, so that when you pay or if in the content of an airdrop, it's a little different because share drop, because you're just getting it, but in like a token purchase agreement or something like that, or a staff, you really need to understand what's going on. The team is strong. Can the team actually build this, or have they leveraged a third party like Republic Advisory Services to kind of help out on some of these things? So a lot of questions, but really, really interesting opportunities in the space that I'm like super excited about.
I have one quick question before we. I'm going to open up to a couple other questions we have from attendees. Nominee structure, or SPV. You mentioned 12G at the beginning. Managing a whole bunch of investors is really, really hard, but a nominee structure or an SPV can make this a lot easier. And I think it's good for both the investors and the issuers. That's my opinion. Joel, thoughts, comments on that?
Yeah, so there's some real differences between the nominee structure and the SPV structure in who is the ultimate holder. Right, from the SPV structure, the ultimate holder is the SPV, whereas the nominee structure, it's going to be the investor. They're going to be the beneficial owners at that point. The ownership is going to be the difference between owning a loan and owning units, or being a unit holder or shareholder. So that you have to keep in mind that there are some real significant differences between them. They are getting more popular, and one of the points Mario raised earlier, which is knowing how many investors can come in before some reporting happens, an SPV structure can often enable some of a delay at the very least, because an SPV structure is just a singular holder. But when it's an SPV, you don't have control over that. The SPV has control over that ownership. So again, if you're looking to really control and get involved with every investment opportunity you're doing, you have to be wary potentially of an SPV structure. If you're looking at the people who are running that as the ones you are going to be good advisors and good, I don't want to use the word custodians, but good overseers of your investment, then SPV structure can be a very interesting opportunity as it diversifies as well.
Okay, Mario, do you have anything to add? I mean, I view it as a win-win. That's my personal opinion. Your thoughts?
Yeah, just on the SPV, we don't love the SPV model because if you look at some of the conversations around them and some of the rules, they are technically a separate legal entity, which require separate disclosures, two separate securities issuances.
You're talking about CF right now, though, right?
Yeah, I'm talking about CF and raising capital using instead of the issuer, it's actually an SPV. That's what I'm talking about. So we actually prefer like having a nominee. So our CrowdSafe we call it the nominee CrowdSafe. The nominee essentially acts as a proxy on behalf of all investors. So when that conversion event, if and when it happens, the nominee could act on behalf of all investors, the crowd holders, and convert them into a custodial account, and that or custodial accounts, and that way you kind of avoid any potential concerns or issues there. So, historically, maybe without the nominee, you had to kind of go out and get each investor to sign a piece of paper. Now with nominee type model, the nominee acts on behalf of a predetermined third party, usually the company's CEO, on behalf of all the investors in the crowdfunding raise. So it's a really easy, powerful way to avoid some of the double disclosure issues that we see with the SPV model, and that's why we've taken that approach.
Okay, all right. So we're running out of time here. Very quickly, I'd like to mention that first you have the company, the issuer, and it has to be a company that can execute on its stated mission. So that's like the first thing. But then you have the platforms. And when I look at the ecosystem of platforms, I view Rialto Markets and Republic as a quality platform that's doing the diligence they need to do to, the KYC stuff, which you have to do, but channeling things down the right path. And that's key. That's important for investors. So, and I don't say that lightly, because again, everything has risk. You're not going to, as Joel was saying, you're not going to get a 10x return on something that's very little risk. You have to understand what you're getting into from the beginning. Valuation is very important. If you're buying something with $1 billion valuation and it's a startup and a single sheet of paper, you're never going to make any money on that, I promise you. And understanding the deal terms, read the deal terms, go through them. If you have questions, ask, because I think all platforms, or just about all platforms, have a Q&A session where you can pose questions to the founder, to the executives, and clarify things. And that's part of the learning process. And that's very, very important. It's also very powerful. And I think it's awesome that retail investors have access to this asset class today. So I'm going to jump over to a couple quick questions, because, yes, we're running out of time. We have somebody who asked about platforms supporting micro VC funds. I don't know. I know. Republic's doing VC stuff. Rialto, you guys have any feedback on that?
From our perspective, an investor is an investor. When you have a Reg A offering, you have a Reg CF offering. It allows for accredited and non-accredited investors to come in. So a micro VC firm, they should look into these types of Reg A and Reg CF opportunities, because there are some really interesting ones that might fit the amounts that they're able to invest. Going through the standard procedures as they are available for other types of investors seems to be a strong possibility that will actually boost the company's brand name, as well as the investment opportunity and future growth.
We have another question about secondaries and secondary transactions. Somebody mentioned Cedars specifically. Obviously, Republic knows them well. Cedars has been effective in a very iterative way in providing secondary liquidity. I think it's admirable what they've accomplished. Rialto Markets, you guys are just getting started. You have an ATS. Do you want to provide any perspective on the securities that you're looking to trade on your ATS?
Yeah, so from the ATS perspective, a couple of things to keep in mind. Firstly, the Reg A's are available for trading right away. That's the rule. When it comes to Reg CF or Reg D, they have a seasoning period, generally a year before they're able to start trading. When it comes to, we like to say we don't talk about liquidity because these are small offerings. If IBM had a $50 million offering, it would be a very small offering. It's relatively illiquid. So liquidity is a relative phrase, if you will. But the thing that we often stress is price discovery, and having multiple players involved, whether it's retail players, institutional players, liquidity providers, high net worth individuals, family offices, just having the variety is an important factor in determining price discovery. Similarly, being fully disclosed and transparent on any historicals, whether that's been orders that come in, trades that have happened, but just showing it to the entire system so everyone can feel comfortable. And the third one is to be able to get some research. Now, we don't provide any research, but there could be research providers, whether in the traditional sense or who we're working with, not only traditional research providers, but also academic research providers that might give a different angle onto the valuation and the proper price of those securities. Once that happens, it delivers a comfort level to people, for people to buy and sell within the secondary market, and that will enhance whatever liquidity might be available and to grow.
And very quickly, Reg A plus offerings can trade immediately. D and CF, there's a period of time it takes to get there. Mario, did you want to add anything to the secondaries?
No, I think Joel nailed it up in the head there.
Okay. We have an industry insider that's actually asked a good question. What about an issuer who's raised money under CF and then they kind of vaporize? They stop communicating with investors. Do either of you guys have any thoughts on that? Mario, we'll start with you.
Yeah, we we personally don't like that at all, right? Because at the end of the day, we're a marketplace and we serve both the issuers and investors who are on the platform. So we expect there's a level of communication, especially in those communication channels that you mentioned earlier on the bottom, the Q&As. Actually, for CF offerings, all communications by the issuer to investors need to be there. So it's actually really illuminating. A lot of people ask really cool, interesting questions. So it's a great way to learn. So yeah, we dislike it. And at the end of the day, we think that there should be some communication between the issuer and the investors, of course.
You don't or can't compel the issuer from providing updates, though, right?
I mean, you can't compel anyone to really do anything.
Joel, any comments on that?
Yeah, I mean, to Mario's point, we can encourage communication as much as possible, but ultimately, and I suggest investors, look for deals that they want to get assurance of that. But there's no way for anyone, for us, regulators might be able to, but we can compel them.
Somebody asked about the link. Go ahead.
Andrew, I was just going to add, actually, an investor could go and see the communication channels and see if the issuer is actually responding or not before they invest. So it's a good opportunity to say, is this issuer responding or is this issuer not responding to some of these questions? It gives you an idea of how intimately involved the issuer will be. And keep in mind, investors do ask a lot of questions, so there's not an immediate response time. It's not like Slack or something. So just throwing that out there.
I will mention this, that Reg CF and Reg A Plus issuers are required, apparently by law, to file periodic updates. I think CF, it's every year. But as I understand it, they don't always do that. And that's a challenge for the industry. I have somebody else asking about how about some of the language on the platform seems promissory. I think this is kind of a hard thing because everybody wants to, pound their chest and say, this is awesome, this is a great service. But what you can't do is you can't commit to a return. You have to say, we've got a cool business, we think it's going to work well, but you can't promise anything, correct?
And you can't make misrepresentations, right? And that could be gleaned as a misrepresentation or an omission. So when we're looking at the offering pages, and by the way, the offering pages is actually in the issuer's discretion. That's their responsibility to ensure the accuracy of it. And it also has to be accurately reflective on the Form C, which is the offering statement that's filed with the SEC. You want to avoid something like, you're going to make 2x or 3x on the investment, because at the end of the day, there's a very low likelihood of that actually happening, and that's misrepresentative to investors. And also, the regulators don't like to see language like that. So it's really dangerous to engage in that. We don't like to see it, and that's why our language on our pages are much more tamed than some other platforms out there.
I have another question who's asking about pre-money valuations, and that some of the valuations seem much higher than the market. I don't think you guys can you guys can't tell an issuer how to value their company, but you can provide feedback. Joel, am I correct?
Yes, we can tell them how to value their company. What we can tell is the investor to do their due diligence. If you think the valuation is just exorbitantly high, then to the point of this entire webinar, then it's probably not a good deal. You need to be able to look into that and find out something. Like I had stated earlier, you might be able to look at this. It's going to be really difficult to be able to determine valuation based on revenues or profits. These are early stage companies that don't necessarily have that. But look at the markets, look at comparables, look at other situations that other companies have been in. And if that can give you some comfort level that the valuation is within range, that's fine. If you still feel that it's way out of range, then may not be the best deal for you.
Okay. All right. We're really running out of time. I'm going to let each of you, give your parting shot of words of wisdom as to what investors should look for. Mario, start with you.
Yeah. So just to sum it up quickly, look at the reputation of the platform. See if they have a diligence process in place. See if they're actually providing some sort of scrutiny on their deals, vetting them not only for outright investor harm and fraud, which is their obligation pursuant to the federal securities laws, but also are they conducting some diligence, or are they just letting anyone on? So that's kind of the first thing. The second element is evaluate each opportunity independently of one another. Look at the company, evaluate it like you're really like taking an intricate look, and then look at the securities instruments and the offering documents that are on the page, because each one are different. And you can't kind of put them all together. So really platform, company, and then specific terms itself. And then I'd say a little less emphasis on don't be sold by the offering page, which is really the purpose of that page is in fact to be almost like a sales element to it. So those are kind of the three things. And also Republic.com, if there's any issuers on here, or if anyone wants to recommend an issuer, you could feel free to reach out to me at Mario@Republic.co, and I'll be happy to chat with you about the opportunity to see if it makes sense now or in the future. And again, we do Regulation CF, and we also do other regulatory exemptions up to $75 million. So it's really kind of a one size fits all, in a way, kind of plug and play platform that we've created here. And I'll just say the last thing, a few of our companies have gone on to raise from Andreessen Horowitz and some big time investors. So it's really an awesome time, and happy to speak to anybody individually if you reach out.
All right, Joel, words of wisdom.
Just quickly, when you're looking at an investment, buy this story, not necessarily the stock, right? Make sure that that's a really good opportunity that's going to grow. And if you have a small percentage because you only put $500 in, that's fine. If it's going to increase by 100 times, you're going to make some nice money out of it. The second thing is I would check out to make sure that the issuer has who the issuer has engaged to help them in their raise. Have they gone through the process correctly? Have they gotten an auditor? Have they gotten lawyers? Have they gotten a broker dealer? Have they gone through to make sure that they've gotten all the component parts that show that they're serious? And if they have done that and they've been willing to pay the money to get those players to help them out, then they're probably a serious type of issuer, and one that you might feel a little more comfortable putting your investments in. Again, it's whether it's Reg A or Rialto. Also, we do Reg CF, Reg A, Reg D. Doing all of these, that applies really to every one of those companies. Make sure they did it the right way. And if they did it the right way, and it's a company that has a really good story to tell that looks like it's going to be able to go to the next level, Series A, Series B, C, D. Nowadays, companies are staying private for more than 13 years. 20 years ago, it was 4 years. So they're going to be private for a while. Make sure that their next round and the next round are up rounds, that they're going to be able to get to positive kind of growth. And those are good investments.
Those are great points. I want to thank Mario from Republic and Joel from Rialto Markets for sharing your wisdom, sharing your knowledge. You guys are great. I know you guys are working hard to provide quality issuers to smaller investors, and I really appreciate the work you do. This is kind of a whole new world where smaller investors have access to a class of investment that they previously were blocked out of and boxed from. Joel, you make a great point that back in the day, companies went public at a younger age, and there was an opportunity to gain capital returns with other investors. That doesn't really exist anymore. Now you have to jump ahead of the line to get in at the private stage, and that's what you guys are doing. Thank you, all the attendees who've participated in this. Next month, we're going to be talking about secondary markets and ATSs, which is a hot topic. A bunch of questions regarding that we didn't get to, but hopefully you'll register for the next webinar next month, and we will see you soon. So thank you very much for everybody. You have a great day.